So the topic of today's presentation is how not to miss a major top and how to grab a market bottom. Now, two massively huge and massively important topics, and we only have 30 minutes. So I'm going to have to go at a fairly good speed and not too many details, but let's make the best of it. This presentation is based on what I previously presented, taught, published in spiketrade.com. Spiketrade.com is the group that I run with my friend and partner, Kerry Lavborn. Here is a brief list of the tools I'll be showing you today. The weekly charts, we're dealing with major trends, so the weekly charts are on the menu. The impulse system, force index, the new high, new low index, average true range channels, ATR channels, something that my partner Kerry is very hot about, has been for many years, and industry groups and subgroups. Now, most of this stuff you can see in my book, the new trading for a living, and all of it is on Spike Trade every day, almost every day. A quick comment about this elephant in the room. You know, an elephant in the room is the topic that everybody is thinking about, but nobody talks about. And of course, the elephant in the room is this horrible virus that erupted from China and now hitting the entire world. In Spike Trade, we follow the news, and not so much the news, but we follow the most important, most valuable resources relating to this health emergency. And just to show you a slide, which you can probably copy paste later or just copy later, which shows a couple of absolutely fantastic videos about this emergency. One about how it developed, and the second about how to avoid getting infected. But let's get back to business. There used to be happy days in the market. And of course, this is the bull from Wall Street. And oops, the happy days have ended. That was 2008 stock market crash, bear market crash. The happy days came back, and most of us had a wonderful time celebrating, and then we had a bear market again, 2020. So the question is, how do we catch? How do we identify those major bull market tops? That's our goal for today. But as you look at this chart, and these little red circles mark intermediate tops until we get to a major top at the right edge of the screen. I just saw a few notes that folks complaining about the audio. Any better now? Well, considering how many people we have in the room, nearly 1,000, and we have 4 complaints, I strongly suspect it's at your end. And comments are coming in, audio excellent, no problems, Okay, great, let's continue. So in any case, as the bull market goes on, it teaches all of us a terrible, terrible question. Oh, sorry, terrible, terrible lesson. And the lesson is this, as you look at these little red circles. If you hold long enough, you will be okay. And it works as long as the bull market continues. And then, of course, Mr. Bear comes roaring in. And this lesson turns out to be a terrible lesson when a bear market begins. So we will be looking at how to identify market tops. And before we do that, just a reminder, this comes from one of my classes on Spike Trade. This is the market paradox. To be a successful trader, you have to be strong, and you also have to be humble. You have to be strong, perform your work, perform your analysis, look at the screen and say, here it is, and push that button and place your order. And you also have to be humble. You have to be aware that the market is stronger than any of us, that nobody, and I mean nobody, has the perfect knowledge of the market. Unexpected things can always happen. You always have to protect yourself from all sorts of eventualities. Anybody heard about using stops? So this is the market paradox. Be strong and be humble. Not so easy. So back to catching major tops. To exit around major tops, and you cannot really realistically expect to catch the top. This is the week of the bull market top. I'm going to catch it. Good luck. Ain't going to happen. What's a realistic aim is to exit around the major tops. And I suggest you need two sets of tools for that. One is signals that a top is coming in, and those signals will help you anticipate a top and exit, and perhaps exit too early. If you miss those signals, the second set of tools, or actually one tool, comes in, a safety catch. When you're trading, you're performing a high wire act under the roof of the circus. What if your hands slip? Are you going to go down 20, 30, 40 feet, or will there be a net to catch you? So that will be the second tool, a safety catch. Let's begin with early signals first. And here I will use the example of the current, of the latest bull market and the current bear market to show you the tools that I use. This is abbreviated from a presentation I did on Spike Trade, and over there I did an in-depth review of 3 and eventually 4 bull markets: 1987, 2000 with the 2001 crash, 2008, and now the latest one. So here we go straight to the latest one. This is the chart. This is the weekly chart that starts in 2015 at the left edge and proceeds to just a few days ago. What we see here is prices are traveling as they always do in an envelope, for which I used ATR channels. ATR is essentially standard deviations. And when the market goes 1 or 2 standard deviations away from the moving average, that's pretty normal. 3 standard deviations is a lot. Outside of 3 ATR, the market gets pretty crazy. You see this manic episode here. Our patient is manic depressive. You see this depressive episode here, and the manic episode just recently, and of course a major depression at the present time. How can we identify the market approaching a top? Several tools. First of all, I track the new high, new low index on the weekly charts. And whenever the weekly new high, new low rallies above 2,500, it confirms a bull market. What does it have to do to achieve that number? There were approximately 4,000 stocks listed in the New York Stock Exchange. So in order for the new high, new low index, the weekly index is 5 latest days. So you have to have 5 days on which you have 500 more new highs than new lows. Has to be pretty strong bullish. And you can see that the last confirmation of a bull market from this indicator came in June of 2018. So the rally continued for another year, a year and a half. But the leadership was not quite as strong. Not a signal to run, but a signal to be alert. A couple of other signals. This chart, again prepared by my partner Kerry Lavorne, it shows in the upper pane what happens when the S&P shoots outside of +3 ATR channel. When it does that, you better be very, very, very alert. The market has gone manic, the market has gone crazy, and craziness never persists. At the right edge, the panes number 2 and 3 track an indicator we call industry groups and subgroups. There are 228 Morningstar groups and subgroups, and every weekend we apply the impulse system, which I developed a long time ago, described in all my books. We apply the impulse system to every group and subgroup. So if we have, and then we count how many groups are green, how many groups are blue, and how many groups are red. Green bullish, red bearish, and blue neutral. So if the green groups are above 120, it's a bullish reading. If the bearish groups are in excess of 120, it's a bearish reading. And this indicator has been very good about catching bullish stages in the bull market that began in 2016. So you can see here at the right edge of the chart a bearish divergence. The next chart, and this is pretty much the chart off of which I trade. This is the chart I look at whenever I'm making my trading decisions, strategic decisions on the weekly, tactical decisions on the daily chart. What you see here again and again repeats. The S&P goes, the weekly chart of the S&P goes outside of the plus 3 ATR channel, and that's a dangerous signal. But what's happening as we zoom in to the right edge, in between there were lesser signals when it came near the 3 ATR, but didn't quite penetrate it. What we see at the right edge of the chart, and this is 2020. This is our current year. The S&P closes outside of plus 3 ATR chart. New high, new low index. I'm sorry, MACD histogram makes a new high. Force index makes a new high. There is a bit of a pullback and then a rally to a new record high. And at that point, there is a bearish divergence of MACD histogram, a bearish divergence of force index. I mean, the bell is being rung. And of course, in Spike Trade, we kept posting these charts and augmenting those bells. So what happens if you don't get those signals? Or what happens if you decide, well, sometimes those signals are too early. Look how early it was in 2017. It was followed by another major buy, but that's another story. What if you miss that signal? For that, we will need to develop, I'll discuss it in just a few minutes, a safety net. But first, allow me to summarize the early signals that warn of a major top. In the background, bull market is several years old. Weekly new high, new low is below plus 2,500 for many months. And then S&P closes above plus 3 ATR channel on a weekly chart. And the new high, new low shows weekly and daily bearish divergences. Those are all loud bells. If only one of them rings, that's okay. If two of them ring, that's also probably okay. But when all of them start ringing at the same time, don't plug up your ears. There are some additional signals. This is something I pay a lot of attention to. Baltic Dry Index, that's the cost of shipping, a very sensitive indicator of world economy. Baltic Dry reached a multi-year high of 2,500 in September of 2019. By early February, it was down to 400. 400. It lost 80% of its value. And then, of course, the whole thing started imploding. Another tool that I keep an eye on is there's a wonderful service out of Minnesota called Sentiment Trader. The guy who writes it, Jason Goffert, have a lot of respect for him. He has a very nice way of keeping his fingers on the pulse of the market crowd. And he has something called dumb money confidence and smart money confidence. And when those things go to a 40 or 50 point spread, be alert, be very alert. And then another optional sort of sign of a bear market approaching is a generally happy mood of mass media. Market Watch, of course, is a great cheerleader. So this is the summary of the signals that a major market top is approaching. Time to exit, sell your stocks, take your profits. Now we have to switch gears and go to how to escape with minimal damage if we do miss the market top. Obviously, we need a stop, and an emergency stop, not a trading stop. Trading stop has to be fairly tight. An emergency stop is a -2.5 ATR on the weekly chart of the S&P. So we plot a weekly chart of the S&P. It has a 20 plus weeks moving average, and then we'll calculate ATR on that weekly chart, subtract 2.5 ATRs from the moving average, and place a stop for the week ahead. What happens? This was the bull market that just ended, the bull market of that ended in 2020. Look at the behavior of plus 2.5 ATR. It's certainly not a trading thing. It's too far away from prices, but you don't want it to be close. You really want it to be the final safety net. And look where it caught the S&P on the way down. Tremendous slippage. There was a downward opening gap, but anybody who exited here, I'm sure, is very happy today. Let me show you a couple of other examples. Here is the -2.5 ATR stop for the year 2008. If you recall, in 2007, the market was going higher, higher, higher. Everybody was happy, and by the way, Baltic Dry began declining from 10,000 in those days down to 1,000. Talk about early warnings. But with the -2.5 HR stop again caught this terrible bear market at its very early stage. You got a scratch, but not hit with a paw. We can go even further back. Year 1987, if you traded that far back, another happy market, closing S&P closing above +3 ATR and saying danger, danger, danger. But if you did not listen to that, you still should have had this stop, and this stop got you out of this market very early in the beginning of the crash. So remember, the -2.5 ATR for the S&P, for the weekly chart of the S&P, is your last tool. You really want to exit sooner than that. But in case you miss, this is what you want to use. Well, let's turn the page. Catching a bottom, deep sea diving. The best signal for catching market bottoms is a spike signal. A spike signal occurs when the weekly new high, new low index dips below -4,000 and then rallies above that level. What does it mean for the new high, new low, for the weekly new high, new low to dip below -4,000? Just think about it. There are approximately 4,000 shares listed on the New York Stock Exchange. You have to have 5 days back to back when you have 800 more new lows than new highs. I mean, you really have to have this market badly, badly, badly hit. And what happens, the weekly new high, new low drops below -4,000. When it starts rising above that level, it means that all the weak hands have been shaken out. That's it. The panic is over, and now the buying begins. The signal is so important that back 12, 14 years ago, when we were first organizing Spike Trade, we named it after that signal. Here is a little busy chart of the weekly new high, new low index. It begins in 2007 and goes to 2012. Next chart, I'll show you what's happening today. And you can see this line marked with green. That's the weekly -4,000. S&P kisses that line, and it's a beautiful buy signal. Kisses it again, buy signal. Touches it, buy signal. And then something unusual happens. As the bear, and the signal works in a bull market, like here, and it works even in bear markets. It gives you rallies in bear markets. But here is a massive danger sign. You know what, let me hold on that. Let me show you some more good signs. Here was the latest sign that on this chart in 2011. Kisses the -4,000 line, and the bull market resumes. The danger sign. The danger signs occurs when the new high, the weekly new high, new low index drops not only below -4,000, but below -8,000. Just think about how to achieve that number. You have to have 5 back-to-back days when there are 1,600 more new stocks making a new low than new high. In other words, half the stocks on the New York Stock Exchange have to be hitting a new low for the year. Just visualize the amount of panic. And when that happens, and then eventually new high, new low rallies and comes up above -4,000, we get a rally, a little rally. But those super deep -8,000 bottoms, this is the line that marks this low, those bottoms need to be retested until finally we have a new high, new low, bottoming out below -4,000, but above -8,000. And the signal occurred on March 9th, 2009. I mean, this was this is one for the books. This was the bottom of the great bull market. Here was a little follow-up signal. So spike is good, super spike, not so good. Super spike tells you to expect another decline, another retest of the lows, and to expect a spike to a level more shallow than super spike. Let's see what's cooking now. So this is the current chart updated through a few days ago. You can see a spike signal in January of 2016. And if you remember, that was the end of the mini bear market that we had and the beginning of the bull market. December of 2018, when the market had really a nasty correction and the weekly new high, new low dropped below -4,000 as soon in the first week of January, as soon as it rallied above -4,000. That was the start of a beautiful bullish trend that went on for a little longer than a year. In this super fast bear market that we just suffered through, the new high, new low index came well below -8,000. It actually reached nearly -10,000. And now we're having a rally. So what to make of it? We're in a bear market, I think. We're having a pressure reducing rally. And this rally may well go for several weeks, maybe even a couple of months. But eventually a return to the March lows appears highly likely. Here is the summary: super fast bear market, pressure relieving rally. Today is day trading paradise. If you day trading now, I don't encourage day trading among beginners. It's a very demanding skill. You really have to be a very competent trader to do it. You have to act almost without a thought. You have to trade. You have to be so much in tune with prices. If you're a day trader and you stop to think, you're dead. However, if you know how to day trade these days, it's our paradise. Markets move hugely, volatility is great, but you really have to know what you're doing. This is not the time to learn day trading. If you know how to do it, by all means. If you don't know how to do it, wait for later. And so while this rally is going on, expect more volatility, and I'm awaiting a retest of the March lows when a spike signal will occur. And of course, in preparation for that, I'm slowly, no great rush, but I'm slowly starting to develop a shopping list. You want to have your shopping list pretty well organized before it's time to go shopping. All right, that's pretty much what I wanted to deliver to you today. If you would like to continue with this kind of education, please visit Spike Trade, take a trial. We don't have free samples, but you can take a 2-week trial, see if the site is for you. You like it, you stay. You don't like it, in 2 clicks you can cancel. If you're viewing this video and send me an email, or send Spike Trade an email, and you can say Alex Elder was teaching this class and he promised he promised a free new high, new low index ebook, and we'll keep this offer open, let's say, for the month of April. get it. If you would like to get in depth into what I'm teaching and doing, read my book, The New Trading for a Living, translated into 16 languages, used by funds around the world to teach their trade, to train their traders. Take a look. Probably not the worst book you've ever opened. And that's pretty much what I wanted to say to you. I finished 5 minutes early, so I will look into the room and I'll see if there are any questions. Someone is asking, will you share with the recording? Yeah, I think. Look, this is a Traders Expo event, right? I am just a guest. Traders Expo apparently is planning to put this tape online. Feel free to review. Mark in Alabama, old friend, says Spike Trade is awesome, highly recommended. Thank you very much, Mark. Very kind of you. Michael is asking PDF and recording. I don't know, Michael. Ask Traders Expo. You know, some questions have no answer. Are you bullish in this current market? Well, I've been shorting all day today, day trading, right? So am I bullish for the next 10 minutes? Am I bullish for the next 2 weeks? You know, a question like this, are you bullish or bearish, makes zero sense. Let's see. Someone is asking the new high, new low. It is called the new high, new low index. Look, if you want to put new high, new low index on your screen, I have good news for you and I have bad news. The good news, it's very easy to do. You don't need any special software. You do a spread. You get the number of new highs and spread them against the number of new lows. As simple as that. The trouble is that most of the data for new high, new low is dirty and unreliable at most websites. It's shocking, but true. Everybody shows the same stock prices, but what they show for new high, new low is, for lack of a better word, pornography. There is one source that Kerry and I trust in Spike Trade, and that bar charts. Bar charts has very clean data. So we have a database which we built manually, going back to, hold on, to 1978, right? So if you're going just to go to any which software and plug in whatever new high, new low data they give you, you know, it's not going to be very good. You have to get it from a good source. Looking into the room, Robert Wolf in Germany, thank you very much. Max is reading my book, The New Trading for a Living. Thanks for the read. I don't know, did you get it in English or in Spanish? The Spanish translation is actually very good. I met the translator. Tom is asking, how can we get the new high, new low indicator? Tom, it's everywhere, except to understand how it works. It really would pay for you to read this new high, new low ebook. Just a few dollars, and you can get it free at Spike Trade if you join as a trial member. Jeffrey is asking how to chart the -2.5 ATR. Jeffrey, I remember seeing you in Spike Trade. You didn't ask that question then. It's something that we would put into, you know, how to chart it. I mean, it's not something one can answer in a minute remaining in this Q&A period. Roman is asking, please explain the Baltic Dry Index. Very good question. Baltic Dry Index is the cost of dry shipping. So world commerce moves by boat. Now, if you order, you know, an iPad, it may come by a plane, but almost all world commerce moves by boat. And Baltic Dry has nothing to do with the Baltic Sea, just exchanges on the Baltic Street in London. That's the cost of hiring space on those cargo ships, and this is a super sensitive indicator of world economy because they see what people are shipping and how much it costs. let's see. Thank you all thank you all who are putting these wonderful comments. I mean, I could just read them and and enjoy the rest of the hour. Is your new book available digital? Yes, it is. Yes, it is, and you can get it at Amazon. You can get probably a slightly better version if you come to elder.com. Ours is less restricted. Amazon puts handcuffs on you. Thank you for signing my book a few years ago. It's a pleasure. If you order it from us, I enjoy signing it. Let me ask Traders Expo. We're exactly at 30-minute point. Should we stop at this point? Continue, keep the room open for a couple more minutes? You tell me.
We have about a minute left, so if you want to just take that minute to wrap up. And
great. Thank you very much. I'm told we have about a minute left. So let me go from Q&A back to my presentation, and very quickly take you to the key points. So there are happy days in the markets, and then there are very unhappy days. And the idea is to identify market tops as they develop. Don't be delusional. Don't think that you will catch exact point marked with that little blue triangle. So I suggested several tools with illustrations how to see the signals that a major top is being developed. Now, it is easy to miss a major top, not so much because you don't know the signals, but because everybody is happy in the bull market. The party is going on. Let's open another bottle. You don't want to get up and leave. So just in case you miss it, use the -2.5 ATR stop on the S&P. And then I gave you several examples how this safety net catches incipient bear markets. And then we talked about catching a bottom. Spike signal is what helps us catch all bear market bottoms, all intermediate bottoms. The only big catch is if the spike goes below -8,000, expect a retest, and that's exactly where we are today. Thank you very much again for coming in. I'm going back to my screen, busy trading all morning, and now I guess I'll see if anything cooking in the afternoon. But many thanks to Traders Expo for inviting me. They're great people. I've been speaking for them for many years. Always pleasure working with them, and I hope you enjoy working with them as much as I do. Thank you very much, and have a good day.
Thank you so much, Dr. Elder, for being here. Always a pleasure, sir.